Right, everyone, well, welcome to Fundamental Fridays, weekly series. We'll be looking at the fundamentals driving the markets using macroeconomics, okay? So this week, it was a crazy week. I know you saw Bitcoin tumble 25%. The stock markets tumbled aggressively. The Japanese yen got very strong, and it was all because of last week's jobs data in the United States, where the markets got afraid of the US tipping closer to a recession. And now they're betting on sharp interest rate cuts by the US central bank. Okay, so what we're going to do, I'm going to be walking you through what happened fundamentally this week in the markets, okay? And hopefully it will help us get an edge in our trading for the week ahead, so we know what to expect, especially with US inflation coming out next week, which will be key. Okay, so come over with me to the computer screen and let's break down these markets. All right, everyone, well, welcome to Fundamental Fridays, where in today's video we'll be breaking down what the hell happened in the markets, because we've seen the dollar against the Japanese yen after last week Friday tumbled 8%, Bitcoin tumbled 23%, the stock markets dropped 6%, and it was all because of the market's fears that the United States is tilting towards a recession. And something happened in the markets called the unwind of the carry trade, where the Japanese yen got very strong and it disjointed markets all around the world. Okay, so let's have a look at the headline from last week Friday after the jobs data. Flight from stocks accelerates as fears grow. The Federal Reserve is being too slow to cut interest rates. Okay, the flight out of global equities, which is stocks, is becoming a stampede as increasing signs of a US economic slowdown spur a pivot towards haven assets. So bonds always appreciate when stock markets are falling. And I want to show you what was written just below here so you can understand what the markets were looking at. Okay, listen, as manufacturing and jobs data are pointing towards recession levels, investors are now questioning whether the Fed is cutting too late. Okay, so what was it in the jobs data that made the markets feel like the US is tilting towards a recession? So the jobs data came in, and what was most importantly was the unemployment rate, which has jumped from 4.1 to 4.3%. So why is this important? Well, what you need to understand is the Federal Reserve since 2022, when inflation hit its peak at around 9% in July, had already started raising interest rates in March 2022. This is the macro spreadsheet that I use with my VIP members when we're trading the markets to understand what's fundamentally happening with the US economy using macroeconomics, okay? So inflation was very high. We know what the central bank did in the United States. They started raising interest rates. First hike was in March 2022. The Federal Reserve raised interest rates aggressively from 0.25% to 5.5%. So how did that impact the markets? Well, what you need to understand is it worked, because what the central bank was trying to do was cause people to cut back on spending because their mortgage payments are going up, car loans, student debt, personal loans, business loans. All this debt that was going up in terms of their interest payments every month was squeezing consumers. So the Federal Reserve kept saying in their policy meetings, we want consumers to cut back on spending to bring down the demand for goods and services so businesses lower prices. And they said we will have to tolerate some slight unemployment. But why? So why would that happen? Well, obviously, if businesses are not seeing as much revenue coming in, but at the beginning of the year, the unemployment rate was very low, 3.7%. Basically, everyone in America has a job who's in employment, right? There's only a small fraction of people looking for work. And the Fed said, well, as people cut back on spending, businesses naturally, when they lose out on profits and they're paying a lot of wages, they start to let go of workers quickly so they can keep their profit margins, okay? Especially companies in the S&P 500 that have stocks. They need to keep the valuation of their stocks high by growing their earnings. So the Fed said, yes, people cut spending, the unemployment rate will creep up slowly, and it will give companies the opportunity to cut prices because they're paying less in wages, right? But the unemployment rate in America has gone up very, very fast. 3.7 to 4.3. When you're looking at a population of 300 million people, that's millions of jobs that are being lost, okay? So the markets have said to the Fed, okay, look, you've risen interest rates aggressively, but clearly it's worked because inflation is now back down to 2.5 and core inflation 2.6, right next to the central bank's 2% target. When in 2022, as I showed you guys, the Fed's inflation target was way out of hand. It was at 8% when they first started raising rates. So they've got inflation under control. But now the Fed has told the markets they're worried about the unemployment rate getting too high. And when the labor market starts to unwind, it can happen very rapidly. And if millions of people lose their jobs, what happens? Companies are not going to be earning as many profits. Okay, so when the market saw this data they got spooked. So remember, for the S&P 500 to keep going up in value, and it was just at record highs just a few weeks ago, you need the company earnings of businesses to keep growing, because then the companies are becoming more valuable. What grows earnings? Spending. Okay, so when the market saw that data, and earlier on in the week, the manufacturing data had come out negative, because you see over here, it says manufacturing. Now, the manufacturing data in the United States is very important. It predicts 20% of business earnings in the United States, which makes up a large proportion of the economy. And the data came out at 46.8. It's below the level of 50. And I'll show you, because a lot of people don't understand how this relates to the stock markets, and our professional investors are using the manufacturing data to predict what's happening in the S&P 500. So here is the blue line representing the manufacturing, the year-on-year returns on the S&P 500. The orange line represents the manufacturing data. All you need to understand is this. When manufacturing PMI is below the level of 50 and contracting, earnings for 20% of companies in the US are predicted to be negative. So what do you think investors do when they're seeing the earnings expectations decline? They sell the S&P 500, which is why when the orange line declines, the blue line, which is the yearly returns of the S&P, look, the S&P is going into contraction. You've got the levels of the S&P growth on the right-hand side. So we're looking at anything below 50, we're in contraction territory. The S&P is falling 10, 20, 30%. Soon as the manufacturing data gets above 50, which is growth territory for the earnings of companies, investors are snapping up those stocks all day because they know the earnings of companies are growing. That's why you see the S&P 500 yearly returns go from 10, 20, 30%. The higher the manufacturing data goes, the more the stock markets rise, because investors are using these surveys to understand, are the earnings expectations getting positive or negative? And at the moment, the earnings expectations are turning negative. Markets don't like it. It's spooking them. Okay, so the latest data is telling markets the manufacturing data is negative. Okay, that's why in the report it said investors were worried about the manufacturing data, and then if people are losing their jobs, well, fuck me, manufacturing companies ain't making as much money as they previously were, so everyone's getting out the stock markets. All right, so this caused markets to get spooked. Okay, but also when the Federal Reserve is cutting interest rates, you have to understand what happened with the Japanese yen, which is why if you look at what happened here, look at the headlines. Aftershocks of the carry trade at the heart of the market rout. This was on Monday this week. Okay, so they're saying the carry trade was at fault for why the markets were falling. Yen's rally gains steam with global carry trades in the balance. See the headlines? Okay, you're seeing over here, JP Morgan said this week, okay, August 6th, the carry trade unraveling is only half complete. So what is the carry trade? So the Japanese yen had interest rates, Japan's central bank had interest rates very low for the whole of 2020 into 2024. Okay, this is why the yen got so weak against the dollar. So what is the carry trade? It's when investors borrow money in Japan where interest rates are low and take that money, sell the yen into the dollar, and they buy government bonds in the United States where interest rates are high because they can earn free interest on buying government bonds. And as long as the yen remains where it is against the dollar, or if it weakens, even better, investors can make a lot of money. Okay, so remember what I'm showing you. If I take you over here and I show you the 10-year US government bond interest rate, which is the benchmark, okay, and the most liquid traded asset in the world. So here we go. Watch the correlation between the S&P 500, US dollar JPY, and the bond market. So listen to what happened. Now remember, they're not just buying the US dollar JPY, they're also buying US government bonds, and they're borrowing money in Japan and going and investing it in the stock markets in the US. But let's start off with the currency markets. Look, March 2022, when the Fed started raising interest rates, notice what happens to dollar yen. When rates are going up, look at dollar yen on the right-hand side. The higher interest rates go up, the more dollar yen goes up. As soon as the interest rate on the government bonds decline from 3.17%, you can see it here on the right-hand side. When it declines here, look what happens to dollar yen. Dollar yen declines. Soon as the bond market interest rate keeps going up, what happens? Dollar yen climbs. Soon as you have a decline in the interest rate on government bonds, dollar yen declines. Soon as the interest rate on government bonds takes off again, dollar yen takes off again. As soon as the interest rate starts to decline here, dollar yen declines here, as you can clearly see here. Then as interest rates on government bonds spike up again, dollar yen rallied higher again, okay? And then when interest rates peaked here and came down again, so did dollar yen come down again. So why is the interest rate on government bonds driving the currency markets? And why, since this period of time here, where rates in the United States have been coming down, has it dragged down dollar yen? Now, this is exactly the reason why I this week took this trade of my members. Okay, you can see we recently just closed some of the trades over here. I've closed my Euro USD and my JPY Euro trade and my USD JPY trade. Okay, and we made a really good profit. We literally had our orders in just before the market sold off. Look, you can see we had stop orders here for Euro, JPY, and USD JPY, and it was perfect because my members followed the trade. You had members making £300. Well, this is for some of the earlier trades. If I scroll down, you can see this week members making £900, 2,700, 2,800. The reason we took this trade and the members who followed me was because if you understand that the higher the interest rate in the United States goes, the more investors are using Japanese yen to sell in exchange to buy US dollars and buy the bond market and lock in those higher interest rates. Hence why the more the interest rate goes up in the US, as you can clearly see over here, the more dollar yen climbs. And if the interest rate is declining, USD JPY is declining. And it is rising, the USD JPY. And why is this happening? The bond market, the interest rate in government bonds is going up or down because it's based on the market's expectations for where interest rates are going by the US central bank. So in this spreadsheet, we predict where the interest rate is going every month by the Federal Reserve. Okay, so why is this important? Because what's happened? The Bank of Japan last week raised interest rates. The United States is talking about cutting interest rates. So if you can understand why this rally was so aggressive, and as the markets were selling yen to buy dollars, they weren't just buying dollars to speculate in the currency markets, they were also buying dollars to go into the stock markets. But this strategy only works, number one, if the US continues to have a higher interest rate than Japan, because this is known as the overnight carry trade. And I'll explain it to you. If I look at the USD JPY exchange rate, right? And we have interest rates in the US right now, 5.5%. Interest rates in Japan are 0.25%, right? So if I sell the yen and buy dollars, depending on how many lot sizes you're taking, people don't even understand this. Over 365 days, if I'm a hedge fund and I'm trading 1,000 lots, look how much money I get a day. 150 grand a day gets credited into my trading account. If you take the trade on the reverse and you sell the dollars to buy the yen, where you're getting charged 5.5% interest on the dollars that you sell, which is the funding currency to purchase the yen, but you're only getting paid 0.25% on the yen that you buy. So you lose money on the trade. Hence why when the Fed in 2022 first started raising rates and Japan's interest rate at that time was minus 0.1, now you're going to start to understand the moves. Look, when the Fed started raising rates here and the interest rate started to go up, as the Fed went from 0.25% all the way up to 5.5%, look at the overnight carry, which is why you see in the headlines, it's saying carry trade unraveling only half complete. The market route is down to the heart of the carry trade. The yen's rally gains steam because of carry trades. So this is how it works. Look what happens as the US raises interest rates, 0.5. Look how much money you start to make. So look, it starts off with if I sell the yen to buy the dollar, so I buy the exchange rate, I could be making 10 grand a day if I'm a hedge fund with 1,000 lots. But look what happens when rates go to 1% in the US. I make 30 grand a day. 2%, I make 60 grand a day. 3%, I make 90 grand a day. 4%, I'm making 100 grand a day. 5%, I'm making 150. 5.5, I am laughing. I'm making 160 grand a day. So what do you think all these traders are doing when they know they can get this free carry trade, which is what the headlines are telling you over here, right? They can get all this free money credited into the trading account. Everybody jumps on the bandwagon. All the hedge funds do it. Hence why the higher rates go up, the more hedge funds go into this trade. But this trade only works if the dollar's going up in value, because yes, you could be making 150 grand a day, which is over 365 days, that 5.5% difference in interest rates based on the lot size. But if the exchange rate, for whatever reason, tumbles by 15, 20%, the strategy doesn't work. Because number one, you could earn money credited into your broker account from the difference in interest rates. But remember I said over here, when investors are going into the bond market, your 4% interest rate is only protecting you if the value of the dollar stays strong. If it drops by 16%, who cares about your 4% interest rate? You've just lost money on the trade, because when you sell the dollar back into the yen, you're left with less yen. But remember, you still have to pay back the yen that you borrowed, right? Do you understand? So this unwind in the carry trade is happening because investors are realizing the Fed's going to cut rates. That's why the interest rate on government bonds is now rapidly selling off, because the markets are predicting the US is coming towards a recession. And what happens when the central banks are faced with recession? They slash interest rates. That's why we're predicting so many rate cuts. Look, this is the interest rate meeting by meeting. And what would that mean for the carry trade? Well, look, if you're making 160 grand a day, and let's say you was in this trade from all the way down here, and you're a currency trader, and you've already locked in a beautiful profit on this trade. Let's say you jumped in, I don't know, around here, and you've already locked in a beautiful profit of around 20% plus your 5%, and you're $1 billion fund. That's a lot of money. But what suddenly, if your 100 million in trade turns now into 50 million, 20 million, everybody's trying to cash in on the trade. That's why it's called a sharp carry trade unwind. All the people that was selling yen, buying dollars, and going into the stock markets, who was going into the bond markets, who was going into the currency markets, they realized, shit, for us to keep our profits, we have to lock in our trades now and get out of the trades. That's why all these headlines are talking about the carry trade unwind being the #1 cause for the market sell-off. Now, what happened with Bitcoin? Well, obviously, Bitcoin moves in very tight correlation to the stock markets, if you didn't know. Okay, so look, for those of you who may not be aware of this, as stocks declined in 2022 because of higher interest rates, so did Bitcoin. But look what happens. Soon as stock markets rise here, can you see? So does Bitcoin go up 100%. But then as soon as stock markets fall here, right, and we have this decline in the stock markets, we have a decline, this period here, when you have this decline here in the stock markets, so look, stock markets rally here, so does Bitcoin rally here. As soon as stock markets decline here, so does Bitcoin fall by around 20%. As soon as the stock markets take off here, so does cryptocurrencies take off here. Whenever you get a decline in the stock markets just over here, why do you think you get a decline in Bitcoin just over here? And as soon as stock markets rise again here, Bitcoin rises again here. And recently you've had the sell-off in stock markets here, and Bitcoin is falling here. So why is stocks and Bitcoin moving at the same time? Well, fundamentally, guys, if you understand what drives stocks and Bitcoin, it's the bond market, interest rates. Because as higher interest rates were being implemented by the US Central Bank in 2022, there's less disposable money for people to spend on crypto, on consumer goods and services, which means companies are going to earn less money, which means Bitcoin is going to have less investment. And now investors have ETFs where they can invest in Bitcoin. Bitcoin is now seen as a risk asset. So when investors take risk in their portfolio and buy stocks, they buy Bitcoin. When they sell stocks, they sell Bitcoin. Hence why, when you see over here, as interest rates in March 2022 was going up from the Federal Reserve, look, during this period of time over here, look what happened. Interest rates go up, Bitcoin goes down. But look, as soon as the interest rates hit a peak and started to come down, look what happened. Bitcoin went up. And then as soon as the interest rate takes off again here, no surprise, that's the period here where Bitcoin goes down. And it was only since the interest rates hit their peak in October 2023 and started to come down here did we get a rally higher in Bitcoin. Now, what you need to understand is mortgage payments, credit cards, car loans, student debt payments, these are all pegged to the 10-year government bond. So as the interest rate on the government bond declines, the reason crypto takes off with stock markets at the same time, because I showed you the correlation, because investors know when bond market interest rates are going down, everyone's interest payments are going down. What can people do? Spend money, driving up the value of stocks, driving up investment into Bitcoin. When the interest rate's going up, that's why stocks and Bitcoin go down, because investors understand Companies earn less money is going into Bitcoin. So you can see this week, I literally just entered a trade with my members on Bitcoin as well, because we've been buying off this level all the time. You can see just yesterday, we bought Bitcoin. I just sent a message to the members here because look, you can see my entry price was here. I got in at 57, right? And where's Bitcoin now? I bought just here. Bitcoin jumped up 10%. Okay, we've locked in a healthy profit. Hence why my members this week have won trades with me on Bitcoin. Look, this member made £100. Mark made 300. This member made 1,300. Tim made 5,300 following my trades. Fucking buzzing. And I'm giving the members a lot of education behind the trades. This member made 3,400 on his funded account. Happy fucking days. Okay, Josh made $1,000, $2,000. So what we need to understand, I bought the Bitcoin and I also entered a trade for Aussie dollar, US dollar, and we're in a profit there as well, simply because the Australian central bank turned around and basically said, maybe we're not going to raise cut interest rates. So their interest rate difference is not going to be as favorable for the US anymore. So that's another tactical trade I took. Okay, so guys, all we need to remember moving forward for the week ahead, wherever interest rates go on bonds is what drives stocks, crypto, okay, and the dollar. And not just that, gold as well. Gold has been breaking to record highs, okay? And if you understand what drives gold, you will understand what drives crypto, you will understand what drives stocks. All right, so if I show you, you know what drives gold? Most people don't realize this. It's the 10-year government bond. Let me show you. Look, remember I showed you when the bond yield was going up, stocks were falling with crypto? Well, look at gold. Higher interest rates, lower gold prices. Lower interest rates, higher gold prices. Higher interest rates, lower gold prices. Since then, just like Bitcoin and stocks, lower interest rates, higher gold prices. Gold is a hedge against inflation. If you can't buy government bonds to protect you from inflation, you buy gold. Now investors like to buy crypto. So it's like seen as another safe haven to gold. Right, guys, listen, if you want daily updates, okay, on the markets, come and get involved. Okay, I got a free Telegram channel you can come and get access to. The link will be below this video. If you want access to my trades, you want access to the daily market updates, educational material that I post for the members, you can follow the positions I'm taking in the markets, you are more than welcome to come on board. But if you want to just see what we're doing, click on this channel. I give a lot of education in there. We've got 2,700 members and hopefully I'll see you inside. Okay, so that's Fundamental Fridays. Where do we go next week? Well, we got US inflation. Okay, now what do you think is going to happen if US inflation next week comes out closer towards the central bank's 2% target? Well, we know what's going to happen. The Federal Reserve is more likely to lean towards rate cuts. Okay, and what does rate cuts mean? Lower interest rates on bonds. What does that mean? Higher stocks, higher gold, higher Bitcoin. So next week, if inflation falls, we know where to get into, okay? I think it's Thursday or Wednesday. It's one of the two. Anyway, we'll see. All right, guys. It is... Do you know what? It's one of the two. I think it's next week. When is the inflation data in the US? Oh, Thursday. There's a big one. All right, guys. Fundamental Fridays. Enjoy. Come join the channels.